Hello, everybody. C. Ray Brower here with Corinne Andrews from CrossCountry Mortgage, and we're going to find out about QM loans, niche markets, and all about that other stuff coming up next. And we're back. How's it going, Corinne?
Good. How are you today?
Not too bad. Not too bad. Kind of recovering from the weekend. Got a little bit of unfortunate news over the weekend. My dad passed, so
I'm sorry.
We are dealing with all that stuff right now, but it's all good. He'll be back here shortly, and we'll play a final round of golf with him and spread him and Mom where they asked to be spread. So,
wow. How old was he?
Yep. What's that?
How old was he?
87.
Oh, that's a good long time.
Yeah. He lived a really good long life and was happy just right up to the end. He had been in memory care for about 8 or 9 months now, and he took a tumble and broke his shoulder, and he was on a DNR, and so they just made him comfortable for his shoulder because it was, surgery, and surgery with his heart condition, everything probably wasn't going to be a good thing either. So he was comfortable to the end, and like I said, happy and joking and pinching the girls' butts and everything, just like a dirty old man.
Well, then he went happy, I guess.
He went happy. Exactly.
That's funny.
Went happy.
Oh, gosh. Oh, that's funny.
Yeah. But we have the topic of niche loans and the QM market. So probably the first place we should start, so that everybody really understands what QM means, is what is a QM loan?
So a QM refers to a qualified mortgage. That means that that type of loan is acceptable and underwritten by Freddie Mac and Fannie Mae, and they can be sold in the secondary market. And all the banks follow a standard set of rules regarding those, and everybody knows what they need to do to make a loan under those standard rules, and again, sell them in the secondary market. So then you jump into the non-QM loans, non-qualified, and those are all types of loans, real estate mortgage loans that do not fit in the box for Fannie and Freddie and most lenders. And there's just a huge, big variety of those. And so I have a list with, if we can get through it, 9 items.
9 items. Wow. Okay. Maybe we list them all and then go back and get through as many as we can.
Yeah, you want me to go down the list?
Let's go down the list, and then we'll start at the top and work through what they are and how they work and all that.
Yeah. So
and hopefully we get to the end.
Yeah, and I put the ones towards the top that are used more frequently than others, and you'll see why when I get to the end. So there is the ever popular and famous buy before you sell. So in other words, all the money you need to buy the next house you want is tied up in the home you have today. And so how do you get that money out before you sell it? So that's referred to as buy before you sell. We've got some things to talk about there. Self-employed. Self-employed can have a tough time getting loans. And so there are loans designed for them, for people who are self-employed that do not involve tax returns. So that's specifically for somebody self-employed. The next category is no income or stated income. That's a whole other thing. Then there is another category, asset qualifier. So someone has assets and we use that as income. There's a calculation that's done there. We have special products, non-QM, for investors who are looking to buy rental property. And again, we don't use tax returns on that. Construction loans. You want to build your own house. You have a piece of property, or you've inherited a piece of property and you want to build a house on that. And how do you get the money to do that? That's a whole nother animal. There's lenders who will cover all kinds of different land. And the list here is acreage and hobby farms and unique properties. So we'll kind of talk about what those are a little bit. We've got lenders who will take property in the ownership of irrevocable trusts. That can be a big deal for banks. And we'll go over that. And then the last one that I came across is loans for self-employed people or employed who are in the cannabis income world. So that's a new one. So
that is a brand new one. And
yeah,
the federal government is starting to allow a little bit of that.
well, some banks are allowing it,
At
and
least.
some private investors and things like that. So I did write down the list of states that say, no, not going to happen here. There are 18, I believe, but I have the notes on who they are. But that's the last one on the list, because just a couple of years ago, that was definitely not happening for anybody.
Oh yeah.
But so we've got some changes going on there. So
very good. Very good. So back to the top.
Okay.
And buy before you sell.
Okay. So there's a couple of ways to do that. So again, this is the person who owns a home, has lots of equity in it, lots and lots of equity, wants to, move to where their kids are or whatever, but their assets the house is their biggest asset. And right. It's a tight market.
Upsize or downsize or
right,
okay.
Right. Mm-hmm. And it's a tough market. Sellers are not too keen to accept an offer where you've got to sell your house first to buy their house. It's pretty unlikely in this area that they may accept that type of an offer. So we do a calculation of what your home is worth, how much equity you can use. And what we do is we set up, there's a couple different ways to do this, but one way is we set up one loan, but we take a deed on your old house and your new house. And then you qualify for that loan. Once you sell your existing home, then you can pay that loan down and have the payment reamortized. Okay. So that's one way to do it. Another way is the bank will make a very short-term loan for you to buy the new house. And then we come in and we qualify them for the secondary financing. So that's more of a bridge loan than a cross-collateralization. So you get a loan against your house, and then you buy the next house, and then we come back and do the final financing on that separately.
Okay.
So it's actually two loans that get done instead of one with the cross-collateralization. So I think the biggest hurdle in that is sellers have not heard about this type of financing. Sellers think you're just going to go to some bank and get a straight loan to buy their house. And once they understand it and see the process, they're much more accepting about that. So I've done a fair amount of them over the last few years. It's especially good for people who have been in their home a long, long time. It's hard for, mom and dad to pack up a house they've lived in for 30 or 40 years and just get right out of it immediately. This gives them time to move to the next place, get the house empty, get it staged, not have to be there while people are traipsing through. They're on to the next thing, and they just got to wait for that house to sell. So that's very helpful for those people. And in some cases, you can keep the existing home as a rental if you like as well. So there's a lot of little moving parts that can be done. So there's a lot of options there, but people are just not familiar enough with those.
Which is often the case in this industry, people hear one thing, get an idea in their head, and nobody sits down and explains to them step by step how it really
Right.
works.
Yeah.
And the benefits for both sides, because there's a benefit for both sides always.
Absolutely.
And as long as it's explained properly,
Mm-hmm.
then usually we can work through those kind of things. I understand that really, really well, being from the automotive industry and trying to explain the benefits of keeping a car that just broke down when instead of going and buying a new $40,000 car.
Yeah.
So, you know, this is kind of the same kind of thing in a sense, because you've got lots of equity sitting there available to you, but you can't put your hands on it. It's leveraged money.
Yeah. Yes, exactly. So, it is a niche. It's not for everybody. But it does solve the problem of having a home and needing to get your hands on that money before you buy the next one. It's helpful. Very, very helpful.
Is there a big charge to do that? Is it just basic closing costs and loan fees?
There is typically a fee that goes with it. It can be, just depends on how much you're buying. I would, besides the typical escrow and title and appraisals type of fee, there's probably $10,000 to $20,000 in fees from the bank itself to set that up, whoever's funding that. Now, so that amount of money to me is, let's look at how much money have I made on that house? Is it worth $10,000 or $20,000 to relieve myself of the stress of how am I going to make this all work, and being able to buy what you want and not have to cash out, retirement funds or IRAs and something that's going to cause you a tax penalty in some way.
Right.
So yeah, I think, I've sat down lots of times and, calculated all the numbers and how it comes out and how much have you made on your house. And, just being out of the house when you're not selling it, I think is a huge boost to people. It's stressful. It's stressful to go through that.
It's very stressful. Very stressful to be in the house and people in and out and trying to keep it clean and get the dogs moved and get the kids up and moved and out and not interfere with the buyers and the buyers agents. And it's a very stressful time.
Yes.
Selling your house while you're in it is an extremely stressful time.
It can be. Yes, absolutely. Yeah.
Cool.
Good. So next one is self-employed. And I know we've talked about this a little bit in the past. So this is one of my favorite loans for somebody who's self-employed. So, a self-employed person, the beauty of being self-employed is you get to write off all of these expenses. If you're a contractor or you own a liquor store or you have an auto body shop, whatever it might be that you own, there's a lot of expenses being paid to run those kind of businesses. And the IRS rules are that you get to write off a lot of those expenses, and therefore your income is reduced. Well, that's great because you're not paying as much taxes as somebody else who might gross that kind of money that you are in a business. However, when you look at the standard qualification rules for lending, we can only use the income that's on your taxes. And if you're self-employed, it may not be enough, even though you're making a lot of money and doing very well. So the alternative to that is where we sit down with, the loan officer, sit down with a couple of years of your bank statements from your business. And we go through all the deposits and we see what kind of money you're bringing in to your business. What are you bringing in every month? 20,000, 30,000, 40,000, 100,000, whatever it is.
Whatever that number is.
And we look at all the income. What are you generating? And then we average that over a 2-year. We can do 12 months or 24 months. We average that over 2 years, and we use a big percentage of that number as your monthly income. And so that eliminates the tax returns and the write-offs and why are you claiming this and what are you doing with this money and who owns what.
Right.
And so the effect is that you are able to qualify for a home loan. And again, you can do a standard 30-year fixed loan. You can still do a standard 30-year fixed loan with that, or you can choose an adjustable rate mortgage if you like a 5-year fixed or 7-year fixed. You have some choices, but it's not any kind of crazy loan that's going to readjust in every month or something like that. It is a standard loan. We just use the calculations for income different than using your tax returns. We look at it from another point of view. And
which is great because as business owners, there are a lot of personal expenses that get
yes.
to be written off in your
Mhm.
business,
Mhm.
including part of your house.
Right.
If you've got home office
Mhm.
and your car payments and your meals, and I mean, there's
Mhm.
just so many things that can be
Sure.
written off while you're in business that is actually wouldn't count against you if you were a regular W-2 employee instead
Yeah.
of a self-employed. Yeah,
Right.
makes a lot of sense. Yeah.
Yeah. And so I think the most painful part of that is you got to fork over a lot of bank statements, but it is much easier if you can do that electronically. It's just a PDF file to send over to the lender, and we take it from there and get our spreadsheets out and calculate away. And there are not any special fees or costs around that type of loan. The interest rate is going to be a little bit higher than a standard loan that is underwritten by Fannie and Freddie. It's a different type of calculation. The money comes from banks, and the income is done differently, and they receive a little higher interest for that type of investment. And you can use that on owner.
Seen as a little more risky.
It is, right,
Yeah.
because it's not
Right.
the standard, guaranteed loan of Fannie Mae and Freddie Mac.
Right.
But yeah, I've done a number of those, and in many cases, someone will come to me and say, here's my tax return. Somebody's telling me I'm not making any money. And I'm like, well, that's the way it looks on your tax returns. How about your bank statements? And they're like, I don't know anything about that. And then all of a sudden they're like, oh, we can do this now. This is amazing, because we were told, we were going to have to change our tax basis and redo our taxes and all kinds of crazy things like that.
Right.
So I really like that one for the self-employed. I really do. It's a bit of paperwork, but I think it's a fair assessment of their actual business circumstances.
Right. Right. I think when we actually spoke about this loan, you had finished up one for a liquor store and said, I want to buy a liquor store.
Yeah. Boy, there's a lot of money. And the other thing about that is it doesn't matter if people are happy, if they're sad, or if we have a normal economy. They're still selling a lot of liquor and
go to the liquor store. Yeah.
It's just kind of funny. Yeah.
Happy, got a drink. Sad, I got a drink. Yeah, things are good. I'm going to drink anyway. Just have fun. Yep.
Yeah. That was pretty amazing. So anyway, funny. But yeah. Yeah, good. Let's see. Another one we have on the list here is no income stated or verified. So this is for someone who has a lot of assets, owner occupied. You need at least 20% down, but you state an income. Or I shouldn't say stated. We don't list an income. There's no income listed, but you have to have assets, a fair amount of assets. And that is for owner occupied only. Again, 20% down, probably better terms. I'm sure it's better terms if you can do more than that, but you've got to have really good credit, and you have to have assets and a lot of reserves. So that's kind of a basic one. Again, it's not going to go through Fannie or Freddie, but it's you can have an ARM or a fixed rate loan on that. That's kind of basic.
When you're talking about owner occupied, you're talking about owner occupied moving into the house they're buying, correct?
Yes. Yes. In
Just
other
so
words, you can't
everybody's
buy a
clear on
rental.
that. Yeah.
Yeah, you
Right.
can't. It can't be
Right.
for a rental property. Correct.
Right.
Yeah. Um, we have another one that again is in the non-QM category, and we refer to it as an asset qualifier. So sometimes you have people that have huge amounts of money in the stock market, mutual funds, um, retirement funds, IRAs, the old Keogh plan.
Annuities.
Hmm?
Annuities.
Yeah. So we take a look at all that, and we have a calculation we do that says, okay, we will give you credit for 50% of those assets, and we will count that as your annual income, and then divide it up by the months. And so we use that and do a calculation and say, if you have this much money, we know you can easily spend X dollars a month to be able to qualify. So that one is a fair amount of people have that one. We have one for investors for rental properties. And normally, if you're buying rental property, you're getting an appraisal on the property. And then the appraiser has some additional reports that they provide that says the average rent on this property is $4,000 a month or $5,000 or whatever it is. And so then we, the lender, use that. If you're buying a rental property, we, the lender, use that to calculate how much money you are going to be taking in from this rental property. Do you make enough money? Will there be enough money? Do you have reserves, etc.? And if you own other rental properties, we will also add in what you're making on those other properties, and we will look at the full picture. Now, there are investors who will do a loan for you for rental property and will not look at the tax returns at all. It's just based on the rental income only. Now, you need really good credit, you need assets, you need money in the bank, and you do need some landlord experience as well. So this is very handy for people who own, I've seen lots of people that own 15, 18, 20, 25 rental properties, and gathering up all the paperwork and providing that, and mortgage payments if there are any, and tax bills and insurance is a tremendous amount of paperwork. And sometimes it is just easier to go straight to something else where you're not looking at all the other stuff. You're simply looking at that property that they are interested in buying.
That property is going to cover the loan. So for people that want to say what that is, that's a DSCR, debt service cover ratio.
Yes.
Loan.
Yes.
Correct.
Yes. Correct. Yeah. So, and Fannie and Freddie do not do this kind of thing. This is a completely different animal for someone who's an investor.
Yep.
Construction loans. You want to move up to Tahoe, and you've got your eye on a piece of land up there, and you want to build your dream house up there in Tahoe, or maybe Arizona or Seattle. I don't know, wherever you want to go.
Wherever the dream is.
Yeah. So you can do that a couple of ways. If you already own the land, then you go strictly right over to the construction phase and you get a construction loan. And the construction loan, you present your plans and your contractor's information to the bank. They look at all that. They decide whether or not they want to make that loan. And if they do, there is an amount of money that is provided for that. Your contractor gets like a fourth of it up front because you already own the land. So he or she starts their work on the house. When they're a certain percentage through with that process, the bank gives them another big chunk of money, and they get to the next phase of the house. And then, there's the final piece of it where they do the final funding. And then after that's all said and done, there's appraisals, there's inspections. Then that line of credit that you had to build the house now turns into permanent financing, is done there. Now that is very similar to when you don't own the land yet. You can also get a construction loan, for the land and the construction, and then it goes down the same road where, the contractor turns in, there's the plans by an architect, there's a contractor that you're using, they have to be approved. Every piece of that gets looked for. This is not a quick process. This is probably 9 months to a year, I would say, just depending on where it's at, what the weather is, how much work the contractor is doing at that time, how soon they can get inspections, can you get the materials that you need. We saw people having tile that's being shipped from Italy. It gets held up in, what's that big port down in LA? I can't think of it right now. I've seen stuff where I've been told, well, the tile's all sitting in this port in LA and it hasn't been approved to be downloaded or offloaded yet. And that took 8 weeks, and it just crazy stuff like that. That happens in construction. Right. But yeah, those loans are readily available as well. If you want to build your own house and have it designed and make it exactly what you want. It is a long process. It's not for somebody who needs to move in 30 days. It's just not going to happen. Yeah, it's a long process.
Building a house isn't usually done in 30 days.
Right. Yeah, I know.
But so everybody's clear on that loan. Now you own the land or you don't own the land. We'll mm-hmm. just go with own the land. Mm-hmm. So now you have an asset. Mm-hmm. Are they going to need to come up with a down payment, or is this more like a line of credit on the final cost? That would be question number one.
So you're still going to need to come up with a down payment. They're going to want some more money. Yes. Yeah. Okay. Yes. Perfect. It is very expensive to have your own home built. Yeah. Because along with that, and if people don't realize this, every house that gets built, even if it's a builder building, 15 or 20 homes, every lot has a big tax or fee that is charged by the county and the city that you're going to build that in. And mm-hmm. those are things that you still have to pay, even when you're just building your own home. You cannot get away with not paying those. Right. I don't know if all states are that way, but I'm betting they are. But yeah,
connection fees, permit mm-hmm. fees,
yep,
review fees, fire department. Yeah, they all get involved and get their share.
Everybody gets a piece of the pie. Yep, it is not for the faint of heart.
Exactly.
You just can't.
And then second, you was talking about the builder getting a quarter of the money up front so mm-hmm. he can get started, and then there would be draws along the way. Yes. How does the interest work for somebody doing that? Is it just on whatever you have draws on, or is mm-hmm. it on the entire amount? You've actually got the entire amount there and you're paying interest through the whole time.
So it works like a home equity line of credit. There is a line that the money is drawn on. So let's take this back.
Back up the truck.
That's not my phone ringing. I'm not sure. I hear a phone.
Not mine.
Okay. How odd. I don't think it's something on my computer. How weird. Okay. So during the construction phase, when you have that line of credit, there's generally there are no payments due on that. It's accruing interest. And then when you get done with the house, then it turns into permanent financing. That is typically what happens.
Okay. That makes sense.
Yeah.
Cool.
Yeah. Let's see, I'm looking at the time here. I'm just going to just bring up a couple of things. There is availability of loans on hobby farms, other unique properties, lot loans, irrevocable trusts. So banks don't like irrevocable trusts or property being held in irrevocable trusts because they have a concern that if they have to foreclose, that they won't be able to get their hands on that property to sell it in order to offset any losses.
Right.
Multiple single-family residences on one lot. That is tricky to do. Fannie Freddie is like a house and then an ADU, an accessory dwelling unit. Those are pretty acceptable overall. But more than two houses on a property on a single parcel, it gets tricky. There's also options of loans for people who do not have FICO scores at all. And again, this is all out of the box type of stuff. Now, real quickly on the cannabis income. So that financing is allowed in all states, but, and I'm going to read you the list. Hang on.
Okay.
Here we go. Arkansas, Hawaii, Iowa, Kentucky, Massachusetts, Maine, Missouri, North Dakota, Nebraska, New Mexico, New York, Oklahoma, Rhode Island, South Dakota, Vermont, can't read my own writing, West Virginia, and Wyoming. There you go. Everybody but.
Those are the ones you
will say
can get financing.
Cannot.
Wow.
Yes, cannot.
What I expected you to say, and you didn't, maybe it was your writing, was Kansas, because it's illegal in Kansas to grow. I was kind of shocked when you said Oklahoma, because it is legal to grow in Oklahoma.
Yeah.
Who knows? I know it's legal to grow in Oklahoma because I just watched, I think it was Dateliner 2020, where it was Oklahoma, and they've got some huge farms that they're bringing labor from across the border somewhere. And they had several deaths on the property that the people that had been hired to farm hadn't been paid and were shot, killed on the property. So it's a crazy industry to be in, for sure.
Yeah.
For sure.
Yeah. And
but
I can't, I'm looking at the guidelines for these things, and it just lists that, this particular lender will take cannabis income, and it says these are the states we will not lend in for that. But I don't have any other real information. And if it came up, I would really dig in a lot more and, see what they mean about that.
Right. Exactly.
Yeah.
Exactly.
And I have done loans for people here in California that work in dispensaries. So they've got regular paycheck, W-2s from a corporation who owns that dispensary, and that works. But in the past, the owners of that corporation, that was where the problem came in. And I'm not sure if that has loosened up at all. It's not something that I've run into. Only the actual employees working in a dispensary.
Right.
Oh, yeah.
Well, it's been a very informative day, Corinne. I really appreciate you coming on. Everybody has any questions about QM and niche loans, Corinne Andrews, CrossCountry Mortgage. Her information's been scrolling down below, and you can always see Ray to find your perfect home. Any questions about real estate, make sure and give me a call, Corinne, for any kind of financing, and go out and be the sunshine in somebody's rainy day. And of course, share, like, click, subscribe, all the different things that we're on, because sharing is caring. Thank you so much, everybody. We'll see you all later.
Thank you.